Go.
Welcome back to Academic Market Insights for another edition of Floor Tales. And we are super excited for our guest today. And with that, Dr. Russell Rhodes, aka Dr. Rowe, will be introducing our guest today.
Larissa actually got in contact with Henry and has worked with Henry before, but I used to bump into him at a Starbucks all the time, and then we would cross paths professionally, etc. So I was really excited when Larissa asked me if I knew him and if I thought he'd be a good guest on Floor Tales, and the answer to both was yes. So I'm going to let Henry give us a little bit of his background. He started on a trading floor when most of us are mowing lawns to make money. So
that's not quite fair because I actually was mowing lawns when I was 12 years old.
Oh, geez.
Yeah, but by 14, you were on the floor.
I was. So, yes. Okay.
So that's usually the first question that we ask is what was your path to the floor? Was it by accident? And take it from there. And I know you can take it from there. We've been doing 30 minutes of prep. So,
thank you, Larissa, and for inviting me to this wonderful opportunity. My name obviously is Henry Robinson-Duff. I actually started in the financial business way back in the day when I was 14 years old. Was the first year that I actually was a runner on the floor of the New York Stock Exchange. I was very fortunate back then to actually be a runner for J.C. Bradford and Company out of which I don't believe they're even in business anymore, but it was a very nice mid-sized firm. And from there, it evolved to where I worked in a number of different positions throughout my summers. And interestingly enough, I bounced from working on the floor of the New York Stock Exchange to being a canoe guide up in Hudson Bay for the summers where I would take kids for canoe trips on 1,000-mile canoe trips. But again, back and forth where I was doing this and doing a lot of things throughout my college career. And honestly, when I was in college, I was more interested in political science. And when I graduated, I really didn't have any interest. So I was at home looking for a job that summer after graduation, and my dad turned to me and said, "Hey, the New York Stock Exchange is hiring summer interns to be runners." And I'm like, "I'm at home. I'm not being charged rent. That's beer money." So I immediately started working on the floor as a runner for the exchange, because back then the exchange ran most of the those type of operations in support of the brokers and the specialists, and fell back in love with the business. And it really was something. It's all about the excitement. It's all about the energy. And to me, I looked at that and said, I could be on the floor or I could be at a desk. And I'm like, 9-to-5 desk, that I had no interest whatsoever. I was hooked on the adrenaline. I was hooked on the business. From there, I went to being working for George LeBranch and Mike LeBranch on the floor for their specialist operation, which obviously became one of the largest operations on the floor, but moved on from there after 2 years when the New York Stock Exchange was starting the New York Futures Exchange. And that's when I had my first experience as a market maker, standing in a pit, actually making markets and taking transactions, both in currency transactions. I can remember them today. It was the German mark, Swiss franc, British pound, Japanese yen, and I think that was it. There might have been one more.
There was five. I always feel like there were five.
There was five.
So it'll hit me while you're talking. But Swiss franc, D-mark, the yen, Canadian dollar.
Yes.
Canadian dollars.
Those were the primary places where I first started trading. And back then, that's when you had Paul Volcker stepping in. That's when you had the Saturday Night Massacre, where all these guys got fired and Volcker ended up coming in and everything else. But part of that was the the difficulty with inflation. Inflation was running rampant. We were going through the oil crisis back then because there was OPEC had just been started back in 1973, and there was a lot of contentiousness between OPEC and the United States going on then. Prices were exploding for that period of time. You look at prices and you look at, well, it went from 35 cents a gallon to $1. What's the big deal? But back then, obviously, that was a significant factor, both in the economy and everything else. That took inflation rates out of control. And that's where you started seeing T-bonds trading roughly between 14 and 16%, which meant you weren't getting you were getting huge moves in the market. And for a trader, that's what you want. You always want volatility. Yes, Larissa, it sounds like you had a question.
I do. Just to put things in perspective for like our students, not necessarily our number one fan for this one, but where are T-bonds now? Where do they normally trade? So because 14 to 16%.
I think they're at 4.5%.
Oh, no.
Okay, so yeah, I believe they're roughly around 4.5%. And I think the Fed funds rate, I was talking to my friend this morning, I believe the Fed fund rate is running about 3.25, which is a little bit above where the actual that's the Fed fund future versus the actual cash market. So that market is giving you an indication that there is going to be some kind of there's going to be some kind of action from the Fed over the next 6 to 12 months. And that's always a good, looking at the Fed fund futures market is always a good indicator on trying to figure out what the Fed is going to do. But I mean, you're now getting into what we call predictive markets. And I'm sure you guys have talked about that a little bit in some of your stuff. And it's just, that's a whole nother thing. Anyway. Getting back to starting on the futures exchange. From there, I actually went to the Amex for a while, worked there for Tucker Anthony, which was the brokerage arm for Prudential, and did a lot of retail business with them, and felt that was a little boring for me. I wanted to get more involved. One, I wasn't a broker by mentality. I was more of a market maker at that point in time. So I was wanting to move to Chicago because that's where the option market is. That's where the Board of Trade was with the commodity market, and the interest rate markets were there as well. I was able to get hooked up with a firm called Abelow iHouse, which was originally funded by the Bass brothers out of Texas, and moved to Chicago and started doing mergers and acquisitions out there until 1989. And then through 89, I was independent for a couple of years, actually working with John LaRock. And then John Nigerian at Mercury Trading made an offer I couldn't refuse. And I went there as one of the managing directors for him for a couple of years and moved on from there as well. And went back in 2000, I went back to trading for my own account.
I'm going to throw a curveball at you, and honestly, if you're like, I got no idea, but I'll cut it. But the Chicago, so I've always liked when things didn't work, and the number of futures products that have been out there that didn't work out. And New York actually beat Chicago to financial futures with the currency futures you're talking about, but Chicago ended up succeeding. Do you have any? I've never really talked to anybody that was around for all of that on the New York side. I have on the Chicago side, and I'm just curious if you have any thoughts on that.
Well, the mentality from the New York Futures Exchange side was most of their financing for market makers came from specialist operations. So the mentality was more of a stock or equity transaction type of area where you had specialists and you had and you didn't have competing market makers standing in a pit. Where in Chicago you had the competition where it came more from the commodity side. But I'll be honest with you, the CME, the Chicago Mercantile Exchange, actually listed the currency markets before the
Oh, did they?
Yes,
Okay.
they did. Both, yeah, because at that point in time, we were trying to, if you will, we were trying to poach their market.
I gotcha.
We were trying to get business from them. And the obviously the establishment of especially the Treasury bond pit was so well established at that, even back then at that point in time. There was no way that you were going to poach that kind of liquidity. And that's really where investors would look at the marketplace, is making a determination about the liquidity of the market to decide where they wanted to invest. Because back then you didn't have the type of trade through rules that you have today. Where today is when you have a posted market, you couldn't trade through the bid and offer. Back then, it was cowboy Wild West. It was a free for all. There was no such thing as that kind of rule taking place. In fact, even down on the floor when you were trading, you could have the trade through rules. Now, what would happen is it would be self-enforced by other market makers or other brokers in the crowd, where they would go, you can't do that. That guy over there is actually bid a penny better, or however you wanted to break it down, or he's offering a nickel better than where your transaction takes place. And that's how they first started self-enforcing that, what we call trade through rules at that point in time. And that became more significant as we move into the mid to late 80s, when the NASDAQ started listing, well, not when the NASDAQ, when the exchanges started listing NASDAQ equities on the floor for option transactions. So they started listing options for equities that were listed on the NASDAQ. And back then, the NASDAQ had multiple competing market makers, which they do today, but there was no rule to stop trade throughs, which made it more difficult for market makers back then to make markets, because they would get run over by somebody that would trade through the market and had a position, and then they would want to offset that position in the option market. And we weren't able to do any offset because that pricing was not available to us at that time, because you had to go to individual brokers to get your pricing for your bids and offer. You couldn't just go to an open marketplace. You actually had to pick up the phone, call Merrill Lynch and say, what's your market? And their market could be significantly different than what Goldman Sachs was. And you were either going to take the time to shop your bid or offer, whatever the case may be, to these other brokers, or you had to take whatever that broker was willing to offer or bid, depending on whether you're trying to buy or sell. So the confusion in there could be a benefit, but it could also be a detriment depending on the type of transactions that you were trying to accomplish at the time. So there really was a Wild West. Larissa, I see you laughing and smiling.
It's so amazing. Because for our students, the idea of them picking up a phone to do anything is pretty would be amazing. But we have to remember this happened all before electronic markets.
So the electronic markets didn't really start coming into place until the early 1990s. You did have some formulative aspects of that, going back to certain trading firms. Somebody like Timber Hill was one of the first algo electronic market makers on the floor. And of course, when they first came down on the floor, they would walk into a pit with a computer, and it was frowned upon. This was not the way you did business. You had to use your own brain to decide how to value marketplaces. In fact, it went to, at one point in time, they weren't even allowed to put the computers in the pits themselves. They actually had to have clerk booths around the floor where they would have televised screens color-coded to option markets, and where they would look and the trader would have to look across the floor to that screen to see where his markets were. He wasn't even allowed to have a computer in the actual pit back on the SIBO floor. They were a little bit more lenient on the Amex floor. They actually did have that, and sometimes sometimes I don't know if that's because Tom Pettifee, who founded Timber Hill with Makata Metals, hired only women back then, except for Mario Van Peebles, the director and movie guy. His father was one of the original 6 traders for Timber Hill on the Amex floor.
Wow. Wow.
Okay, you're getting a lot of history from me.
It's just amazing. And again,
So,
this is it. We just really appreciate you sharing this with us because it's not necessarily as recorded as it should be.
No.
But speaking of history, one of our favorite questions to ask is, what was it like on some of the more volatile days, or as Russell likes to call them, the what's it, volatility days?
yeah.
Volatility event days, like
I call them volatility events. It doesn't sound
volatility
as
events.
negative.
And
Well,
so
it's
like
not
what
that
was
it's negative. I mean, volatility is an
Well,
aspect of the especially in dealing as an option market maker. When I moved to Chicago in '84 and really started getting involved with mergers and acquisitions, and of course back then interest rates had come down a little bit, so premium pricing became a little bit more controlled. It wasn't to the extent that you were looking at back in 79 and 78 and 79 when you had high interest rates. Interest rates had started to come down at that point in time. Another aspect that had changed from then to the mid 80s was the aspect that prior to 79, they didn't trade puts. So there was really only, and then when they started trading puts, it wasn't for all option classes. It was only for a select few. But by the time we got to 82 and 83, they had come to the realization about the relationships between puts and calls, that across the board, all equity options had puts and calls, so that you could start looking at certain aspects of the business, the synthetic transaction of buying a put and selling a call, to being short a stock synthetically, or conversely selling put and buying a call to be long the stock synthetically. Those types of transactions started to have a lot more meaning for the market makers because it took certain risk out of the marketplace. And so it became much more of a mathematical transaction than just taking the bat out and swinging on volatility days. But getting back to volatility, one of the biggest volatility days was October of '87. At that point in time, I was on the floor of the SIBO. I was one of the senior floor officials, and one of our responsibilities as a floor officials is going from pit to pit if there were considered violations or regulation extensions beyond what would normally be acceptable in the pit. So honestly, on that day, because the communication between the New York Stock Exchange and the SIBO floor became very disjointed. And part of that was the markets for the underlying stocks, which had normally been, is usually quoted back then in 12ths or eighths or quarters, as opposed to pennies that it is doing today, which they didn't start doing that until the 90s. When they started, so it was still done in fractions. So in most markets, you get about a quarter wide market in general. At that point in time in 87, you were seeing markets for stocks, a $30 stock was having a $5 and $6 wide market. That's how disjointed the market had become at that point in time. And that's also what became a real issue on the SIBO floor, because what was happening is the firms were coming in because they knew what they had on their book or whatever they had, and they didn't really need to know what the market was in general from the New York Stock Exchange. They could step in and try to perform a transaction. And in a lot of aspects, the market makers were getting run over. And we had certain rules about with the markets, which obviously were now being violated by the New York Stock Exchange. So we had to change the rules on the fly in order to accommodate what was happening on the New York, because we're still the tail that was being wagged by the dog. So we still had to have some kind of control over the liquidity and still presenting some kind of market to the public. And it became more and more difficult throughout that day. So as a floor official, I was running around from crowd to crowd, just trying to manage and get everything in some kind of semblance. And I'll be quite honest with you, there were also a number. So as a market maker on the floor of the SIBO floor, you have certain responsibilities that were inherent rules of the exchange, that you had responsibilities to conduct business on the floor. And if you made a transaction on the floor, you were expected to stay on the floor throughout that day to make markets. And you were required to stay when you're in a pit and a broker comes in, you're required to provide a market as a market maker for that particular broker for a transaction. They didn't tell you had to be 1,000 up, or they didn't tell you had to be 1 up, but you had to provide some semblance of liquidity to the marketplace. And of course, with what was happening on the New York, it became more and more difficult to do that. So what we had to do then is suspend some of the rules as far as bid-ask differentials, to suspend those rules in order to be able to accommodate what was actually being presented by the New York Stock Exchange. So it became chaos. Chaos certainly did reign, and it was a day I'll never forget for sure, both as a market maker, but also as an official of the exchange.
I'm still blown away by a $5 or $6 bid ask spread. I mean,
for a $30 stock, yeah.
For 30.
For $30 stock. I mean, it's simple when you start dealing. Obviously, when you start dealing with stocks and you start looking at, when somebody says, "Oh, the stock had the index had a 1% move." A 1% move today is not as significant because the index pricing was a lot lower back then. The 1% move in '87 has a much more significant impact to the actual market than a 1% move does today.
Got it. Now, how would you say that compares to the volatility event at 9/11? Because we've been hearing a lot of 9/11 stories.
Well, I mean, certainly when you go back to 9/11, a lot of what was going on was the uncertainty. And the uncertainty made that one of the more difficult aspects. And there was a certain aspect of volatility that was involved back in 9/11. But again, going back to '87, it paled in comparison. You did have, when they reopened the markets after being closed for 5 days, you did have significant initial movements. But the markets itself still had a little bit more of an orderly aspect to it. You didn't have a total breakdown that you had in '87, but your volatility, you still had volatility, but it wasn't to the point where your market spreads were as wide as they had been before. There still was some width, and there was still some price movement that got on because of the uncertainty of where everything was going back then and after 9/11. But again, I think to my perspective, it still had a certain semblance of order to it.
Okay. That's a very different interest take than what we've been hearing. So I'm
Yeah.
it's nice to hear, and correct me if I'm wrong in my
Yeah.
understanding that we had actually learned quite a bit from the 1987 crash. And the markets had been learning how to handle some of these things a little bit better, how to create better order, how to create better liquidity, how to behave almost in a better manner so that they can be more sustainable. Is that correct?
Oh, I think you're absolutely correct. I think one of the reasons after, well, you had 87 and then you had the crash as I put it, in 89, when you had the collapse of the United Airlines deal. And of course, I was on my honeymoon then. So I was on my honeymoon with my partner. I knew something was wrong because I was in Spain at the time. And I went to convert dollars into, I forget what the Spanish, I think it's the Spanish lira. I went to convert my currency to the local currency. And the jump in conversion rate that had taken place from what I'd done on a Friday to what I did on a Monday was so significant. I actually called up. I knew something was wrong with the marketplace. And this was before the New York had even opened on that Monday. I called my partners back in New York and I said, "What's going on?" And they said the United Airlines deal had collapsed, which had caused the whole market to steamroll on its way down at that point in time. So you had what I would call a crash or a mini crash that occurred in 89. But again, if you look at volatility, it was more of a natural aspect of what was going to happen anyway, whether it was going to be United Airlines that was going to cause it or some other economic factor that was going to cause this volatility spike following what had happened in 87. And again, when you roll into 9/11, you had the economic dysfunction of 99 and 2000 that ultimately rolled into what happened in 9/11 because you had the whole internet bubble that occurred earlier. When that collapsed, that brought the markets down and then was starting to have an upswing. Then you had 9/11, which brought it back down again. So again, it's about evaluating volatility and taking it from a bigger picture standpoint than just taking a snapshot of just that one day or 1 week, as you will.
Well,
That you have to, go ahead.
yeah, I was going to say, and I think that's similar to what happened in 2008 as well.
Absolutely.
So people love to quote, 2008 is when the crash happened. Well, but you're forgetting what happened in 2005, 2006, and 2007. And I like how you described the mini crash because we had these little
You had these fluctuations.
Yeah.
going into it of and then when Deutsche Bank and Lehman Brothers, pardon me, collapsed, that was the catalyst.
And by the way, I was at the Roosevelt Hotel the day that happened.
Oh no!
Yeah, because I was actually working for One Chicago back then, doing some marketing for them, and I was in New York when the whole thing happened, and I was actually going to hedge funds and talking to them about single stock futures because when you had the liquidity crisis of 08,
right.
These hedge funds either had to sell their stock or find a way to have a cheaper way to finance their positions. And single stock, if they had rolled their positions into single stock futures back then, they would have been able to recapitalize without effectively changing the marketplace.
Okay.
But because a lot of the major firms like Goldman Sachs don't want their customers doing that, because where does Goldman Sachs and where do some of these firms make their money? They make their money between the bid-ask borrowed loan rate for these hedge funds. So if you take these hedge funds out of that marketplace, then Goldman Sachs is losing a primary revenue stream. So they were never very popular with that. They would use it themselves for their own account, but they didn't want they weren't about to go out and market it to to other people, which was unfortunate.
Mm-hmm.
And that was one of the things that I was part of my job back then, was to go out to talk directly to the firms. And we were starting to get some success. And then we ran into a little bump in the road and moving on from that. So, but again, talking about 9/11 and what was happening there, the markets had changed significantly from what was going on in 87 to what was going on in 9/11 because of certain regulations and because of what had happened, what significantly happened. You had more electronic trading. You had more, the speed of the business had picked up. You had high frequency trading that was I would say, very well entrenched at that point in time. And it was starting to become more orderly. And you look at let's talk about the volatility today. You have the kind of volatility today that you have seen over the last 2 years with what is changing. Obviously they call it the Trump trade or whatever, however you want to describe it. But it is a certain aspect of the markets itself when it's going through transactions or transition, I should say, not transact. When markets are going through transitions, you're going to have that kind of volatility, whether it's self-imposed or not.
Mm-hmm. Absolutely. So, all right, our fun question.
Okay.
You get a bunch of boys in a tight space like a trading floor, and hijinks ensue. Go to it.
Okay. Hijinks was definitely a very strong aspect of the business and always had been, because of the intensity of what was going on the floor, because of the adrenaline that was going on. I always described the trading floors as a locker room. It was like being in a sports locker room because of what was going on. And as you can imagine, as in a sporting event and a men's locker room or a women's locker room, there is a certain amount of hijinks that does go on. One of the great aspects of when you get introduced to the marketplace is a thing that we call looking for a box of upticks. So in the marketplace, obviously, when a stock trades up, it is upticking upwards. So when a stock is trading down, it's got downticks. So one of the things the specialists on the floor of the New York Stock Exchange used to do for newcomers is they would ask that newcomer to go around. If their stocks were trading down, they would go around, they would ask that newcomer or runner to go around and find them a box of upticks. And then they would send them around the trading floor asking all the individual specialist firms or brokerage houses, excuse me, where can I find a box of upticks? Of course, everybody's in on this whole joke. And this poor person would be wandering around the floor aimlessly for 3 or 4 hours trying to find a box of upticks. And of course, that was one of the more exclusive. There were a lot of other things. They used to powder shoes. If you were getting married, what they would do is they would put angel wings on your shoes, unbeknownst to you. They would have paper cutouts that they would scotch tape wings to the back of the heels of your shoes, and you would walk around the floor. And of course, all these people would be hooting and hollering, and you would start hooting and hollering, not realizing they were hooting and hollering at you. So there was a lot of levity that would go on.
Yeah.
Some of the most incredible stuff was the jokes that they would tell as well. Some of them were very risque, if you will. For instance, when the unfortunate incident, when going back, one of the first times I remember hearing something of an inappropriate joke was when Natalie Wood had drowned on her boat out in California. The first joke that I heard after that was, "So what kind of wood doesn't float?"
Oh, no.
Natalie Wood. Yeah.
Natalie Wood. Which, again, there's a certain impropriety to it, but there's also a certain quirky levity to it, is probably the best way I can put it. So there's certainly, from the standpoint of all that pressure and all that adrenaline that is going on, there were certain aspects or certain things of how to let out that interest, whether it's through pranks or through jokes or through just interacting with their friends. There was a lot of different ways on the trading floor that we had ways to communicate that or express ourselves.
I like that. Express yourselves.
Yeah.
And Larissa's going to take us home.
Okay.
Henry, I can't thank you enough. We can't thank you enough for coming on and just giving us this great interview. We thoroughly enjoyed it, and we really appreciate your time. For those of you who have hung with us, we appreciate you as well. And if you like this video, please hit like. And if you haven't already, please subscribe. We are very excited about this series and are thankful for our guests like Henry. Thank you.
Larissa, it's been a real honor. Thank you very much for inviting me. It's been fun catching up with you guys as well.
Absolutely.